Hello, welcome. 374 of us now. That's great. So thanks for subscribing. And also, if you're new to the channel, a particular warm welcome to you as well. So with the news that's come out with the new virus variant, there's been a bit of a sale in the market, you could say, on some stocks, in particular growth stocks been dropping a lot. So I've been monitoring my portfolio, looking for opportunities to reduce my risk by lowering my average cost basis in quality companies. I found quite a few of them. There's 7 companies I already own a position in part of, and I've increased my position in the last couple of weeks. So I'm going to go through those 7 with you here today. Just a very high level explanation of the rationale. So stay tuned to see where I've been spending my money to help me achieve my long-term £1 million challenge. And that's the main focus of the channel if you're new. I also do stock reviews and a bit of personal finance and investing principles as well. We're going to start off with the big dog, and that's Alibaba, which you'll see on screen now. And I've been owning this company now for a year. Now, I opened my position in December last year at 236, and you'll see here that I've been averaging down over time, reducing that cost basis. And I've recently purchased in sort of mid-November 140 range, 127, 127, and then at 111. That average has come down quite a bit. I'm still 34% per year down on this position, so that's a big number. But I'm thinking this is like a good test to me. I believe that this company is undervalued. I believe it's a much higher quality company than the price suggests. And yes, I appreciate the risk, but I've invested knowing that there are some potential risks there. Can I hold out? The test is I'm putting my money where my mouth is. I'm going to act in the conditions when people are fearful. And I'm going to look at the long-term view where, for me, this is easily a 15% a year return stock. So with Alibaba, I think the intrinsic value per share for a 15% year return is over $200 per share. We've got a massive margin of safety here, with the current market price in the 111 range. I think it's my largest position at the moment, along with the next stock that we're going to discuss. They're the two largest positions. And I recently, last week, I did a bit more of an in-depth view in terms of calculating the valuation and the things that I'm looking at. If you'd like to see that, I'll leave a link at the end, so watch to the end and you'll be able to click through to that one. So next up is Boohoo. Now, Boohoo is my other sort of largest position in the portfolio. Again, I've been holding this one for almost a year, and I've been averaging down over time since that position was opened. And I've recently bought 350 shares at the 170 range, so 27% down on that. I think it's not a problem. If you open a position and a stock you really believe in, it's a high quality company that is to failure and a good upside is going down, and the opportunity there to lower the average and therefore increase your potential future return. But one should be taking that really. So I've bought another £600 or so in Boohoo. So that's increased my position size there. Now, just the usual disclaimer, of course, none of these are recommendations for you to go out and buy, hold, or sell. This is just what I've done. I'm sharing that with you. If you find that sort of thought process useful, you can see what I'm up to and maybe give you some ideas, but do your own research. Now, the thing that I've learned with Alibaba and Boohoo is this chap, Peter Lynch. Now, I'll probably do a review video on that in a few weeks' time, maybe over Christmas. Let me know in the comments below if you'd like to see that. There's a couple of key things in his books. One of them that I've picked up, which I've read a couple of times since I opened my Baba position a year ago and my Boohoo position, is that don't be in a rush to buy stocks. They were both on my radar as high quality companies. I waited for a bit of a dip. You can see with Boohoo I bought at 334 and Alibaba at 236. In particular with the Boohoo position, my long-term thesis was this was going to be a £5 stock. Kind of where I've got to this year is I want a stock that will go 15% a year for 5 years, so double in 5 years. But buying at 333, that takes me to well over £6 if it were to double. And that wasn't the thesis that I had. So I actually gave myself less than 100% upside. So I actually entered that position too early. It dropped down for £4. I thought, 20% drop, let's get in there. But actually, just because one is anchoring, which is a mistake really, against a previous high price, for me, just because it's 25% down, that doesn't mean I should go and buy it. It's thinking about what is the fair value, and then is it likely to give me that 100% upside. Buying here at these lower positions that I have done from July onwards for a £5 to £6 stock, that's absolutely fine there. 100% upside. 170. So I needed to get to 340 to get 100% upside on that tranche, which is actually basically my original purchase position. So my learnings here are don't be in a rush to buy a stock. and also be wary of anchoring, because yes, there's a dip, but buying the dip isn't necessarily the right thing to do if it's still not quite the right valuation for your own calculation. I just thought I'd share that with you, something I've learned this year. Now the next one's Dropbox. I think Dropbox is a great company, sort of 600-700 million users. They're increasing every month, every quarter rather. And I opened that position in Feb in the $22 range. And if we have a look at what's happened, they've been peaking up to over 30, and then you can see here 31 early November, and within a month they're down to 24. Great opportunity to get back in and increase that position size. Got a very close cost base to where I was before. Now I think Dropbox is probably a $45 to $50 stock. The sort of sniff test, Simply Wall Street here has got $53. So again, there's 100% upside there. Next 5 years, earnings forecast to grow at around about 17% a year. So that's above the 15% upside. And that's from 8 analysts. And if you have a look on Simply Wall Street for the next 3 years, for 9 analysts, you're looking at 25% a year. So this is a company that's growing revenue and earnings well, high quality management team. And the other thing I noticed here with the management team, look at this. They're always beating on earnings, and these numbers are going up, 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 and they're beating them each time. So I'm really happy with this company. And I think if it does drop a couple more dollars, I may well sell out of another position to increase my average here, because I think it's a great company, no chance of it failing, and the management's really good. And they're also doing some good share buybacks as well. So the next one is Corsair Gaming. About 25 or so % down on this one. Over the course of the year, they've just been tailing off in terms of the market price, and I've been able to add in the $22 range in recent weeks. I think this is easily going to be a $50 to $60 stock, probably 60 plus actually in the future. I was very happy to improve my position size. And for me, this is founder, owner-led company, good management team. They've also got low chance of failure, very established market-leading products in multiple sort of subsectors within their areas. I've used their products for years, over a decade in fact, so I know about them. And I'm really happy this is one of my largest position sizes. Now again, the sniff test, Simply Wall Street's got $62. That's kind of in the region that I was thinking that they're worth. And I think as a long-term purchase, this is just a nice long-term hold here. Just have a look at some of the stats as a high-level overview. There's a forward PE of under 14, trading PE of 18, and we've got 8 analysts saying 23% a year for the next 3 years in terms of growth. So I think this one's looking good for me. If I'm disciplined here and patient, I just need to hold this one and I will not lose money. I'm very confident in that. Same with Boohoo, really confident that. Same with Dropbox and Baba. Yes, obviously there is the asterisk with some of the risks, but for me, they're well priced in with that massive margin of safety. So those companies, not intending to touch and sell them at all. It's just a case of, if the stock market do the Warren Buffett test for those sort of established growing companies, if the stock market closed for 5 or 10 years, would you be happy to come back in 5 years' time and not be able to sell them? And for the companies we've gone through, absolutely yes. Now we've got 3 on the sort of more newer growth side, sort of younger companies. First of those is Huya. Now, Simply Wall Street says worth 58, which is perhaps a bit of an exaggeration. But this one, I've added to this position here in the $8 range. My average is now about 13, so I'm down, a big fair chunk at the moment, basically 50%. It's my worst performer. I don't want to be adding any more to this. In fact, my position size is a lot larger than I originally intended it to be. But because the opportunity to lower my average has come in, as you can see here, buying at 12, 9, 9 and 8 over the last 6 months or so, I have taken that decision. And this is one where when it gets up above my average, I'll immediately sell probably half the position size because it is too large in my portfolio for how I want that balanced. Now, next up is GAN. Now, GAN's a really interesting one. I managed to get them the 15 range and the 13 range, and now they've dropped below 10, which is crazy. At the start of the year, they said they'll do about $105 million revenue. I think they've done on target for 130, so they're outperforming. Price sales is less than 4, which it's not the most important metric, but for a company that is growing fast, that seems quite cheap. They're doing very well. You see the 130 million for this year, 170 million for next year. Balance sheet is strong. You can have a look at that. There's absolutely no debts there. So I think rule 1, don't lose money. I've lowered my average and the balance sheet is great. So I'm confident that I won't lose money. And again, this is one I can just watch it grow over time as their business there expands and becomes profitable, which they are starting to do. it takes a couple of years in each state they go into for that to click in. And last but not least is Tenant FinTech Group. I've gone in there in the $6 range, managed to lower my average there. And the Simply Wall Street sniff test says 20. I think long term, in the next 5 years, I can see 20 for sure. It's a big growth in terms of the size of their business, and they're going to go from around about 100 to sort of 175 million next year. The market cap's under $500 million, so that valuation starts to improve. The management does seem strong in terms of how they present themselves and the story that they tell. And they kind of got quite a nice little niche there as well, the way that they're operating in. So those are the 7. Click on screen now and you'll see my latest reviews of both Alibaba and Boohoo done in the last few months, which are the 2 largest positions in my portfolio